Hi, thanks for joining me again. Just a quick video today. I thought I'd show you the difficulties a market has when there's weakness in the background. The difficulties in particular in recovering and trying to move higher again. The weakness in this case is seen here. It starts with a gap up bar. Here's a little gap here. But look at the volume. It's extremely high. It probably doesn't match the spread of the bar itself. Extremely high volume and increased spread, but not extremely wide. And that's probably because they were selling in it. Although at the time, you wouldn't have known that. It's a breakout bar, it was absorbing supply. You would have given it the benefit of the doubt. But when price gapped up again the next day on still quite high volume and closed poorly with the next bar down, you knew something was up for sure. And this was fairly high volume. This altogether forms weakness in the background. And until price can get preferably back above this weakness and starts trading up here, this weakness will cause difficulties to the market. It's there, it's not going away. And you can see the market trades sideways for a while. A little bit of support comes in. You can't get any higher here. And then price breaks down at this point here. And that's because whoever was holding the market up over here has sold out and they're no longer in the market. They may have even gone short and they're deliberately pushing a little bit on the market, making it more difficult, continuing to sell into any rallies. You've got weakness in the background. That creates a negative sentiment in the market. And when you see something like this is engineered, this is deliberate. Gap up, high volume, poor close, down bars, an inability to rally in response. It's all set up to go down, or at least go sideways for a fairly significant period while it recovers. So you have a breakdown bar on pretty strong volume, and the next bar still has strong volume. Spread narrows a little bit. Price pushes back up to the breakdown line. This is the breakdown line where the breakdown initially took place, but there's an inability to recover. And that's because people who are stuck over here, still holding, when price is down here, they're saying to themselves, if price comes anywhere up near where I am, I'm getting out for break even, or even for a small loss, I'm getting out. So as soon as price rallies, these people are selling, and that's stopping the price recovering back above this breakdown line. That creates an inability to recover. That creates more people to think, well, the market's going nowhere now, I've got to get out. So you mark the next low. You can see here, it's a shakeout. That's the shape of the bar. A shakeout is a sign of strength, and you would normally see a sign of strength in an uptrend or at a low. This is an attempt to support the market. And you can see there's one bar up in response, but similar to over here, anyone who's stuck in here, they're saying to themselves, when prices are right down here, they're saying if price rallies up, I'm going to get out for break even or cut my losses. As soon as they see price rally, they're selling into it. And that causes the bar to be quite narrow. You can see that here down here, the volume was only low, so demand wasn't strong. And the next day, there's a down bar on slightly increased volume, although still below average. But that's just showing you another inability to rally. And here there's two more little bars where the price goes down but closes in the top half of the bar. They sort of take that shape of a shakeout. They look like a sign of strength, but with weakness in the background, it's going to be really hard for this market to recover Eventually it comes down to here, spread narrows, volume increases. You can see there's a more serious attempt here for the market to turn around, and price moves up. Interestingly, there's a little gap here going over the top of this breakdown line. That shows you that there really is an intention behind most gaps. Rarely do they form organically for no reason. Gaps form for a reason. Over here, it's to encourage people to stay in the stock. The news is probably great. This is probably an announcement of some sort. And the second gap is encouraging people to hold on. And they're only encouraging people to hold on so that whoever's selling, they want the demand to be there so they can sell into it. They don't want anyone else selling into it. So if they gap it up, one, they've got price higher, and two, it's encouraging people to hang on in there while they mark the stock up. The news is probably great, and they can sell into any fresh new demand that's created by the really high rise in price. So over here, you've got another gap up. Now, this is what you would normally see in the market, a gap over an important resistance line. So price gaps over the line in an attempt to recover, but all that happens is it allows anyone that was stuck over here to get out, and they probably did. Sometimes this also happens in larger market cap stocks where whoever's sold out over here may want to open some shorts. So they bring price back. You can see that volumes increased down here. Bring price back up, create a bit more positive news, gap over the resistance line, the breakdown line in this case, and then open shorts in here in the demand that's been created. You can see here that there's absolutely no demand on this bar here, down there, no demand. It's one of the lowest volume bars in this little period, and it was the up bar. So there's another inability for the market to rally back above the new breakdown line here, drawn off this little low. No ability of the market to rally or recover. We mark the low of the next pivot. You can see that here, the market again can't find the strength to break out back above this breakdown line. Mark the next one. You can see this bar here is gapped lower on very high volume. There may be another attempt to support the market here, although looking at this bar, closing below the low of that bar, that doesn't look very good. That's ominous, to say the least. But you can follow that, I think. Here's the weakness in the background. Here's the first breakdown. Here's an inability to recover. This is a sign of strength with weakness in the background. You can see the volume was quite high. They tried pretty hard, whoever it was, but there was no demand and an inability to recover back above this breakdown line. A couple more little minor signs of strength here, but with weakness in the background like this was pretty serious weakness. It was very, very difficult for the market to recover. There was a turnaround here and a gap over this breakdown line, and one bar, that's this volume here, attempted to recover, but straight away there was a lack of demand in the market. Price fell down, came up, no demand. Price broke down again, and there's just an ongoing inability to rally in the market. You can see how it continues to attempt to consolidate, and then fail, and attempt to consolidate and then fail. This is how the market moves lower in a cascading effect until some sort of serious buying emerges, whether that's in the form of a selling climax or whether there's a period of sideways trading with a series of buy the offer bars, which is what I call a vertical accumulation. Either way, the market will find it very hard to rally. No matter how hard it tries, it'll be very difficult to rally with weakness, serious weakness in the background. Okay, that's it for today. Thanks for joining me again. See ya.